Right now, let's call it an airy calm with the banks, right? And while nobody thinks that this whole thing is over, there are some folks who are saying a worst-case scenario has been dodged. While there have been some large outflows, and in fact, the fact of the matter is, folks, let's face it, there's not a lot banks can really do, because the main driver right now is not necessarily fear, it's greed, right? People want a return. People got hip to the fact that you don't have to take 0.00% these days if you have cash. I'm going to bring in Bianco Research President Jim Bianco. And Jim, you know, just let's lay it out there. What you think the real importance of this story is?
What is a bank? You and me and a lot of people watching us think it's a warehouse we keep our money at and they give us a return. But for the Federal Reserve and for bankers, it's the lifeblood for the economy. They hand out loans, and that gets businesses to expand, that gets new businesses to be created. If money is leaving the banks, they can't hand out loans, and that could really hurt the economy. If we're leaving the bank for a money market fund that gives us a higher yield, we might like that, right, but it has an implication for the economy.
So let's talk about money leaving banks. This is a year ago.
Right.
We peaked a year ago, and we were coming out. The air is coming out pretty quickly. $1 trillion. It only became news here. I mean, so if the Federal Reserve is concerned about this, to your point, because they want to see banks lend, how come no one sounded the alarm?
Well, it was really only around Thanksgiving that that number really started to dive down. Because before that, bankers used to quip that you were more likely to get divorced than you were to switch your bank. And that was largely true because it was hard. It was very hard. But now in the era of mobile banking, I could pick up my phone, I could switch my money, and that has changed a lot of things for bankers.
All right, you mentioned money market funds. Let's just remind folks, I think by now everyone kind of knows. So your yield is here, the yield goes berserk. People are sitting there looking at this. I mean, CDs have come back, all these things have come back. And now, of course, those are the yields, and now the assets have also gone over $5 trillion, right? So how does a bank compete against this? How can a small bank compete against that?
This is really difficult for the bank. You and me, if we're talking about people out there, if you have your money at a large bank that's giving you 0.0, let's use a number, $250,000, because that's the limit on it. Pick up your phone, move it to a money market fund, that's $14,000 a year that you can actually increase for yourself in 5 minutes of work. Banks have to compete with that now. They didn't have to before. They have to raise their deposits. The problem is that hurts their profitability.
You know, I bought some treasury bills the other day online, put my account number, bank account, and it just went to the auction. One of the solutions they're talking about, the FDIC is saying, okay, we've got to find $23 billion that we've already used, and maybe the big lenders will pay up. But that's sort of a farce, though, right?
Yeah, I mean, the big lenders will actually be the conduit for the money, but it comes from fees on depositors, and it comes from fees that the banks pay with their depositors. You and me and all the other people that use banks are going to wind up paying it.
Is the worst over then? I mean, or is it just too early to tell? Because it feels like we've become a little sanguine. Bank stocks are up a little gradually for like about 5 days. We built in a bottom. Even the regional banks, we've kind of built in some support here. Is it too early to tell?
Depends on what you mean by worst. If you mean, will we get another screaming headline that a bank has been taken over by the FDIC? No, I don't think we're going to get that. Are people going to continue to say, I'm going to go to that money market fund or T-bills and get 5%, and banks are going to be unsure about their deposits and say, I can't hand out loans to those commercial real estate people or somebody who wants to expand a restaurant because I'm unsure about my deposit base? That can still be a lingering problem until we get some balance between what banks pay and what markets offer.
But the only way you could get balance is if the Fed calls off these rate hikes, right?
Or the banks raise their deposit rates, and that kills their profitability. There's no good answer. The Fed calls off the rate hikes, and we still have inflation.
Right.
That is not an interesting thing. So there's no easy answer here.
All right, Jim. Always great to see you.
Thank you.
Always great. You have the best research. Folks, follow Jim Bianco on Twitter if you're not already. Coming up.